That's how much the Nasdaq dropped in a single session. The worst single-day collapse since April 2025. And if you're holding QQQ, NVDA, AMD, or any AI-adjacent stock right now, that number just punched a hole in your portfolio. But here's what's keeping institutional traders up at night. It's not the 4% drop itself. It's why it happened, and more importantly, what it signals about the next 60 to 90 days. Because this wasn't random volatility. This wasn't profit-taking. This was a market waking up to a macro reality it had been willfully ignoring. And the institutions who saw it coming have already repositioned before you read a single headline. There's a signal buried inside this sell-off. In the options market, in the Fed funds futures, and in the quiet rotation out of mega-cap tech. That smart money acted on weeks before this crash hit. By the end of this video, you'll know exactly what that signal is, why it changes the calculus on every high multiple growth stock in your portfolio, and what specific moves give you the best shot at protecting your capital while the picture becomes clearer. Don't move. This gets critical fast. Let's build the scene. On the day of the crash, the Nasdaq Composite fell over 4% in a single session, the index's worst performance since the April 2025 sell-off, when rate fears first triggered a violent repricing across growth equities. The QQQ ETF, which tracks the top 100 Nasdaq names and sits in an estimated $300 plus billion in retail and institutional portfolios, dropped in lockstep. Semiconductor stocks were hit even harder. The Philadelphia Semiconductor Index, the SOX, shed nearly 5% on the day. Here's why that context matters. This isn't happening in a vacuum. We've spent most of 2025 watching the market price in rate cuts. The narrative being that the Fed had finished its tightening cycle and the next move was lower. That narrative just got torched. This directly affects the positions most of you are carrying. If your portfolio is heavy QQQ, SOXL, NVDA, Microsoft, or any AI infrastructure play, what just happened is not background noise. It's a warning shot. Turn on any financial network right now and you'll hear the same story. Tech sell-off on rate fears. Investors rotate from growth to value. Volatility spike is normal. After a strong run, that's technically accurate, but it's about as useful as telling someone their house is on fire and advising them to grab a glass of water. The mainstream narrative misses the structural problem entirely. This isn't just a one-day risk-off flush. The Nasdaq is already down from its 2025 highs. And the index has now printed two distinct technical breakdowns at key support levels that algo-driven institutional programs treat as hard sell triggers. The 200-day moving average is being tested. That matters. Look beneath the surface and the picture gets darker. Price-to-earnings multiples on the top 10 Nasdaq holdings are still trading at historically elevated levels. The forward P/E on the QQQ basket sits near 28x earnings, compared to a 20-year average of roughly 22x. In a world where the risk-free rate, the 10-year Treasury yield, is hovering above 4.5%, you're getting paid to take less risk in bonds than you are to absorb the volatility of high multiple tech. That spread, the so-called equity risk premium, has compressed to near-decade lows. What does that mean for you? It means tech stocks don't just need to grow to justify their valuations. They need to grow faster than the cost of money. And every uptick in rate hike odds shrinks that runway. The math is unforgiving. While headlines focused on the day's price action, the options market was telling a different story. Put volume, essentially institutional insurance against further downside, spiked significantly on QQQ and on individual chip names. We're not talking about panicked retail buyers. Large block trades in put options don't come from individual investors. That's institutional hedging at scale. Simultaneously, sector rotation data shows money flowing out of information technology and into energy, financials, and healthcare. The classic defensive pivot when rate expectations shift hawkish. This is not a one-day trade. This is portfolio rebalancing at the institutional level, and it typically takes 4 to 8 weeks to fully play out in price action. The institutions aren't panicking, they're repositioning. There's a big difference. But here's the part the consensus is getting wrong. Everyone is treating this as a standard rate fear sell-off. The same playbook from 2022, where you sell tech, wait for the Fed to pivot, then buy back in, rinse and repeat. That's the trade everyone is lining up for. Here's what the data suggests is actually happening instead. The 2022 playbook assumed the Fed's next move was the critical variable. But the real threat in the current environment isn't just one rate hike. It's the possibility that the Fed remains on hold, or moves higher, for longer than the market's consensus timeline. Fed funds futures, as of this week, have pushed the first rate cut expectation back multiple months. That's not a blip, that's a regime shift. And here's why that changes everything. The entire AI trade. The reason NVDA tripled, the reason the Nasdaq ran as hard as it did, was built on a financial conditions story. Cheap money, easy credit, low discount rates making future earnings worth more today. When that story cracks, the multiple compression doesn't just bring stocks back to fair value. It historically overshoots to the downside. The contrarian case isn't buy the dip in tech. The contrarian case is that this sell-off is the beginning of a multi-month repricing cycle, not the end of a one-day tantrum. If this view is correct, then high multiple AI and semiconductor stocks become significantly less attractive over the next 2 quarters. And cash generating, lower multiple names in financials and energy start to outperform in ways most tech-heavy retail portfolios are completely unprepared for. So what do you actually do with this information? Now here's the question this sell-off actually raises. And nobody has a clean answer yet. If the Fed does move to hike rates again, what happens to the $1.3 trillion in AI infrastructure spending that's already been committed by Microsoft, Google, Amazon, and Meta over the next 3 to 5 years? Does rising capital costs slow that build out? Or does the competitive pressure between these giants make the spending unstoppable regardless of rate levels? That answer will determine whether this dip is a generational buying opportunity or the start of a prolonged derating of the entire AI complex. So here's where I want your take. The AI infrastructure spending cycle is so entrenched that rate hikes simply cannot derail it. The Nasdaq recovers fully within 6 months. Or do you think this sell-off marks a genuine regime change where high multiple tech underperforms for the next 2 to 4 quarters? Drop your answer below. The best analysis on this channel always comes from the comments. And I read every single one. If this breakdown gave you a sharper read on what's happening under the surface, the next video goes even deeper, specifically into which individual chip stocks have the balance sheet strength to withstand a prolonged high-rate environment, and which ones are one earnings miss away from a 30% correction. That's a list you want before the next catalyst hits. Portfolio intel. Stay positioned.